Hi, I'm Monk and this is the Monk Way. Let's go back to the basics and look at index funds. We'll see exactly what an index fund is, all the details, the fees, how to buy them, and why they might be all you need in the stock market. By the end of the video, you'll know why Warren Buffett recommends the average person to just buy the index. Watch the whole video because I'll include a way to protect yourself from a stock market crash, which might be coming in the next 2 years. Subscribe, hit the bell, and leave a like for more investing videos. I make these every day. And to join my contest to win a lifetime membership to my investment group, just be subscribed, leave a like, and comment below about anything. I pick a new winner every week. Last week's winner was Kevin. Congrats, man. First of all, what exactly is an index fund? To understand this, we need to understand the market index. Don't worry, this is easy. This is actually one of the first things I learned in investing, and probably the most valuable thing too. A market index is a portfolio of stocks which represents a segment of the market. Basically, it's an index of stocks, or a combination of stocks. This could be a combination of technology stocks, marijuana stocks, retail stocks, or just big American stocks in general. If you had 5 stocks with Apple, Amazon, Facebook, Netflix, and Google, that's technically an index of stocks. A popular index is the Standard & Poor's 500. I'm sure y'all know this one. This contains about 500 of the biggest American companies. All 5 stocks I mentioned are in this index. These companies are so big that this index represents how the American market moves as a whole. This means if the S&P 500 is down, most of the American stocks are probably down today. Each stock has a certain percent rate in this index. For example, Apple might be 3% of this index. Companies that weigh more will have a bigger effect on how this index moves. For example, a small company, worth only 0.05% at the bottom, won't move this index much, while Apple might drop this index by a lot if they had a huge dip today. Some other popular indices are the Nasdaq 100, containing 100 technology stocks like Nvidia, Apple, and Intel. Dow Jones Industrial Average, this one actually contains only 30 stocks. We have some of the biggest companies like Apple, Boeing, Coca-Cola, Visa, and Walmart. So the index is not limited by the number of stocks it can have. It could be very little or huge over 3,000. On the news, you might see them mention the S&P 500 being down or the Dow Jones being up today. These indices are what they are referring to. Now we know what a market index is. Basically a basket of stocks made to track how well a certain sector is doing. But an index fund is not the same as a market index. We can't actually buy a market index because it's just a list of stocks. This is why we have banks offering funds that actually track the index, allowing you to buy it. For example, the Vanguard S&P 500 with the symbol VOO. This fund is just copying the S&P 500 market index, and in theory, should move at the same pace. So we have many companies following the same index. The Spider S&P 500 Trust with the symbol SPY is also the same fund, copying the same index VOO is copying. The difference is usually the fee. Let's see what Warren Buffett has to say about index funds. To quote the master, the trick is not to pick the right company. The trick is to essentially buy all the big companies, do the S&P 500, and to do it consistently. Costs really matter in investments. If your returns are going to be 7 to 8% and you're paying 1% in fees, that makes a huge difference. Basically, he's saying that index funds are a diverse way to not have to pick stocks, and the low fees make a huge difference compared to a mutual fund charging you 1% a year. He also mentioned that if you invested $10,000 in the S&P 500 in 1942, you will have $51 million today. Now we know what a market index is, a list of stocks, and what an index fund is, an actual fund you could buy that copies that list. What are the benefits to an index fund? The biggest benefit is that index funds are passively managed. This means computers are managing this fund. No humans are needed to buy it or sell it, because it will always follow the S&P 500. This also means that no one has to be paid, and the fees are extremely low. The Vanguard fund costs you only 0.04%. So if you invested $100,000, it'll cost you not $4,000 a year, not $400 a year, but $40 a year. This is actually more than 2 times cheaper than the SPY, which is actually the oldest fund for this index. The SPY costs you 0.09% a year, or $90 on your $100,000. This is still pretty cheap, but every dollar counts when you're talking about 50 years or longer. This passively managed fund will save you hundreds of thousands in fees compared to mutual funds, which are actively managed by people who buy and sell your stocks with your money. Hoping to beat this fund, they could charge anywhere from 0.5% to 2% a year, meaning about $500 to $2,000 a year. This is why you should only buy index funds with low fees, not mutual funds. Another benefit is that they actually beat most mutual funds. It's crazy to think a low fee fund can actually beat mutual funds, charging you thousands a year. 95% of mutual funds can't beat the S&P 500 over the long term, meaning that you need a crystal ball to actually find one that beats it. This is why Warren Buffett recommends the average person to buy the index. And the third benefit is diversification. This is the only easy way to own so many stocks and sectors all at once. Just buying VOO will give you a stake in the big tech companies like Netflix, Apple, Facebook, Intel, Nvidia, AMD, and so many more. But also safer ones in food like Coke, McDonald's, and PepsiCo. Even retail like Walmart and Costco. Consumer goods like Johnson & Johnson, Procter & Gamble. Basically, you'll be very diversified after buying this one fund. Never put all your eggs in one basket when it comes to stocks. Index funds give you a margin of safety compared to single stocks. The company in charge of this index actually removes weak stocks and add good stocks over time. This way you're always investing in the best. That's 3 huge benefits. The cheapest way to own 500 stocks beats most mutual funds, and you're diversified. So what kind of returns can we see in this fund? Let's go all the way back to 1993, over 20 years back. The SPY was at $44. In the year 2000, it was at $150, or 250% in the green. Then we had a huge dip, and it was in the red all the way to 2013. But after the redness, we saw $282 in 2019. That's 540% in 21 years. Over the past 100 years, this fund has returned 10% a year in that time. This could mean that we might see 10% a year over the next 50 to 100 years. But that's not a guarantee. A quick lesson I always like to teach is the power of compound interest. Just $400 a month, growing at 10% a year, gives us $1 million after 40 years. This is the easiest and the safest way to make $1 million, which anyone can achieve. If it does return 10% a year in the next 40 years, let's see how much we would get on each level of saving. Using a compound interest calculator, these numbers are all facts. Just $800 a month will end up with $5.1 million. This won't actually be worth that much because of inflation. It'll be worth about $2.1 million in today's money. Basically, you'll be a multi-millionaire if you can just save $800 a month. With $2,000 a month, someone with a good job can easily save, you'll end up with $12.7 million. About $5.2 million of today's worth. If you have a good job and save $5,000 a month, you'll have $31.8 million. Basically, time and a small amount of interest will return a crazy amounts. So how safe is this index fund? This is where I'll show you how to protect yourself from a stock market crash. When I talk about 10% a year, this is only if you kept this fund during the market crashes. If you constantly sell and buy this fund, you'll likely time it wrong and miss out on profits. If you kept this fund for 100 years, it would have given you 10% a year. While index funds are much safer than single stocks, there are periods of time where it stays in bear market for a while. We saw earlier that if you bought in the year 2000, it would take you 13 years to break even. So there are times where you don't want to be buying this, when it's at its highest point. And it's been 10 years since the last market crash. We're at all-time highs in price. This is why we need a strategy when buying in this index fund. The most basic way to keep yourself safe is dollar cost averaging. This just means buying this fund in chunks instead of all at once. Buying it at the highest price means we might just be in the red for years if it crashes. Buying only a few $1,000s a month means our average is lower if it falls. For example, if the price is $100 today, we buy with $10,000. Next month the price drops 10% to $90. We buy more with $10,000. It keeps dropping to $50. After 10 months, our average cost might be around $70. So instead of using all our money, $100,000, on a price of $100, we use all of our money and get our price of $70. This means less of a drop. We only lost 30%, but obviously we're still down 30% compared to 50%. So how do we continue from here? Let's say the market is down 50%. This is the lowest it will likely go. Now we pump as much money as possible in this fund with our other sources of income. This means saving a lot more of your money for the next half year from your job. This is because we get amazing returns if you buy at the bottom. This is not timing the market. We bought in every month even if it goes up. But since we're still making money from our job at this point, the perfect time to buy in is when the market is down. In the last crash, there was about a year at the lowest price. This means a whole year of amazing prices. We could have saved a lot more during that time, and you would be up over 270% if you bought right here in 2009. In the 2000 crash, there was 2 years of a bear market. Saving most of your money here will have made you a lot. So the best way to keep yourself safe is to never buy in with all your money, because this is super risky. If the market decides to drop in the next few months, buy in slowly, and if we're at a point of extremely low prices, save more money and buy a lot. If the price is lower than 30%, that's a great time to buy in more. If VOO drops 30% in the next 6 months, the smart person will only invest half his money in that time. If it keeps dropping, he can save a lot more money and really invest in this. By the end of the stock market crash, his money will be going up 300% over the next few years. Buying at the lowest point in 2009 will have quadrupled your money, giving you a 300% return in 10 years, turning 100,000 to 400,000 in a safe investment. So this index fund is all you need in the stock market. Technically, if you buy the S&P 500, you own a very small piece of 500 companies. This is much safer than owning a few stocks, which is a common thing among young people. Compare a portfolio of Amazon, Netflix, Snapchat, Canopy Growth to a portfolio of 500 companies. You could definitely get away with only investing in this one fund. But remember, the less risk there is, the less reward. If you want to get very rich as a young person, and your job only allows you to save $800 a month, it will take you quite a while to get to $1 million, around 30 years. This is why you can invest a big chunk in an index fund and 25% of your money in single stocks. With single stocks, it's possible to get returns of 50% to 100% a year. So your risk tolerance depends on your plans. If you want to be rich earlier, you have to take more risk. Maybe you want to be 10% a year. You can try 50-50 index funds for single stocks. With an index fund, you're betting that America will do well for the next 50 years. This fund will likely keep going up. Even if it does fall 50% for 2 years, it'll bounce back up. This is not 100% guaranteed, because something bad could happen. We might see World War III or huge natural disasters. But America is a fairly safe country to bet on. And that's all you need to know about index funds. It's It's a diverse combination of many stocks, returns about 10% a year for the S&P 500, recommended as a passive investment by the best investors like Warren Buffett. It's possible to just keep 100% of this fund as your only investment. Buy in slowly to be safe, always buy low and sell high, or just don't sell for 50 years. If you learned something today, make sure to leave a like and subscribe for more investing videos. I make these every day. And check out my stock market group below, where I show you guys every single buy or sell I make in the market. You could have seen me buy Aurora Cannabis before this 50% spike. Keep watching to buy the best index funds, the Monk way.